Here's exercise 3.6. Exercise 3.6 is a little different than the prior exercise. Let's go through the facts and then I'll explain to you how it's a little bit different. So here we are on December 31st, 2010. The Price Company purchased a controlling interest in Shipley Company. What we're given is the balance sheet of Price Company immediately after the acquisition. That appears in this column. And we're given the consolidated balance sheet on December 31st, 2010 after all the consolidating entries were made. So we're given, essentially we're given in terms of the consolidating worksheet, which is depicted here. In terms of the consolidating worksheet, we're given the parent company balances here, which come from this column. And we're given the consolidated balances here that come from this column. In addition to that, we're told that on the date of the acquisition, Shipley Company, that's the company that's being acquired, their equity balance sheet accounts were consisted of common stock $90,000, other contributed capital $90,000, retained earnings of $56,000 for a total book value of the equity of $236,000. So those are the facts of the problem. What we're asked to do is to prepare the eliminating entry that was made here and then back into what S Company's balance sheet was here. So we're working things a little bit backwards. We're given the parent company balances, we're given the final consolidated balances after the consolidated entry was prepared, and we're asked to back in, given the facts, back into what the consolidated entry was and what the target company, subsidiary company balance sheet accounts were. So to do that, we're going to have to fill out our CAD schedule. That should be our starting point. So let's see what we know from the CAD schedule. We don't know the percentage interest that was acquired. We're not told that. We're not told what the purchase price is, but you know we can infer what the purchase price is by inspecting the balance in the investment account. The balance in the investment in Shipley Company account that appears in the parent's general ledger, that balance of $212,000 represents the purchase price paid by the purchasing company to acquire the target company S shares of stock. So, looks like P Company paid $212,000 to buy the shares of stock that they bought from Shipley Company. So we can go ahead and drop that in here as the purchase price. Now, we can't go the normal route and divide the purchase price by the percentage shares bought in order to get the total implied value of the sub, because we don't know what percentage of interest was purchased. But we do know that the consolidated balance sheet here has non-consolidated interest in equity of $37,412. That $37,412 was part of the consolidated entry that was made here. And if you'll think back to when you're developing that consolidated entry, where that number comes from, that number comes from here. It's the difference between the total implied value of the equity and the equity stake that was purchased by the acquiring company. So rather than divide this by this in order to come up with the total implied value and subtract from total implied value the purchase price to arrive at non-controlling interest, instead we can kind of go through the back door and we can say, well, we know that the non-controlling interest was $37,412, so we drop that in here. And if we know what non-controlling interest was and we know what purchase price was, we can come up with what the total implied value was, $249,412. Again, we're working backwards. Normally what we would do in arriving at this is we would take the purchase price, divide it by the percentage interest purchased, and that would give us this number, and we would compare that number to this number, and the difference would be the amounts assigned to the non-controlling interest in equity. But We're given non-controlling interest in equity right up here on the face of the balance sheet, so we're taking this sort of backdoor approach. Okay, so we know the total implied value of the sub. We're provided right here the equity accounts for the sub. The common stock is 90,000, so we drop that in here. The other contributed capital is 90,000, so we drop that in here. And the retained earnings is 56,000, we drop that in here. So total book value of equity, $236,000. So we compare that to the total implied market value of the equity, $249, and we've got an excess here. We've got an excess of implied value of equity over book value of equity of $13,412. Now remember, that can be attributable either to an off-balance sheet asset, to goodwill, or to an asset that is appreciated in value. In this case, we're told here that the difference between book value and value implied by the purchase relates to land owned by the subsidiary with a market value in excess of cost. So that $13,412 is going to go as part of the consolidating entries over here as a debit to the land account. So now, based upon this CAD schedule, we're in a position to go over here and develop what the consolidating entry must have been. Well, the consolidating entry must have entailed a credit of $212,000 to the investment and sub account here. So a credit there. And there must have been a credit to the non-controlling interest account in the amount of that $37,412 right there. And there must have been a debit to the common stock account to get rid of the sub's common stock. And there must have been a debit to the sub's other contributed capital to get rid of the sub's other contributed capital of $90,000. And there must have been a debit to the sub's retained earnings of $56,000 to get rid of that. And there must have been a debit to the sub's land account attributable to this excess of implied value over book value of equity. Again, the debit goes to the land account because we're told that any difference between implied value and market value and book value of equity is attributable to appreciation of the value of the sub's land. So we're going to have a consolidating entry that debits the land account $13,412. Okay, so let's make sure our debits equal our credits. Okay, they do. So now all that we need to do is we need to figure out what number must be plugged in here in the sub column so that when it's added to the parent company amount and is either debited or credited as appropriate by the consolidated entry, yields the final consolidated balance. Okay, so this consolidated balance equals the parent company balance plus the subs balance plus the, since it's an asset, plus a debit minus a credit. That gives this balance. That's stated here. Consolidated balance equals the parent P plus the sub S plus the debit minus the credit. Or just rearrange, and in order to figure out what the asset amount is for the sub, you take the consolidated balance over here, subtract from it the parent's balance here, subtract from it any debit that was made through the consolidated entry, and add to it any credit that was made in the consolidated entry. Again, all we're doing is figuring out what we got to plug in here so that this thing foots across to yield the consolidated balance. So I'm going to plug this formula in. So the sub balance equals the consolidated balance minus the parent company's balance minus whatever debit was made plus whatever credit was made. Okay, so it must be that the cash was $15,000. So I'm going to copy the subs cash. So I'm going to copy that all the way down. And then we'll make sure that everything foots across as a check figure. So this amount plus this amount plus this amount less that amount should yield the same amount in the consolidated column. Let's see if it does. 57,000, 57,000, 161, 161, 337, 337, 220, 220. Okay, so we've got good numbers here. So we have appropriately backed in to the balances in the subs accounts. Okay, so the next thing we need to do the same thing for accounts payable. Basically figure out what amount's got to be plugged in here so that when it's added to the parent company's accounts payable, increased by any credits in the consolidated entry and decreased by any debits in the consolidated entry, it yields the consolidated balance. Or this balance, consolidated balance, equals the parent company balance plus the subs balance plus any credit that was made here minus any debit that was made here. That's what this says. Or you can rearrange it algebraically, and so the formula that you want to apply into the S column here is take the consolidated balance here, subtract from it the parent's balance here, add to it any debit in the debit column here, and subtract any credit in the credit column here. So that's what I'm going to plug in. So take the consolidated balance, reduce it by the parent's balance, increase it by any debit, and reduce it by any credit in the worksheet. So there's the account payable balance that must have been in the subs accounting records. Do the same thing for note payable. Copy all the way down, sum up. So those must have been the liability and equity accounts that appeared in the subs accounting records. And now let's double check, make sure that we're right by summing across this column, make sure that we come up with that number. So we take the parent company's number, add to it the subs number, reduce that by any debits made to these liability or equity accounts, and increase it by any credits made to the accounts. We did get 112.5, so let's copy down, make sure our other check figures are right, and they are. Okay, so what we did is we just looked at the facts a little bit differently. You were given the consolidated numbers and the parent company numbers, enough information to back into what this consolidated entry was, and based upon that then we inferred what the subsidiary balances must have been.